what they're showing here is that stocks are moving at just insane amounts, right? The average stock there is moving 10%. That's just the average. Some of those are moving obviously way more, and the index is not doing anything. If we were down 1% like we are now, and that skew didn't lift at all, what does that tell you? No one's hedging downside. They don't care, right? And that's a sign in and of itself. If you were having this panic fear washout, you would think that IV would be way up here. At which point, then Jack, I may be like, maybe it's time to buy that dip, but we're not seeing that washout. If you're like, what is 10-day realized vol? You'd measure the S&P close to close to as that input. Well, on a close to close basis, there's so much mean reversion now that the vol doesn't seem that high. But if you look at the swings intraday, we'll have 1 to 2% swings intraday, and then the market only closes down or up 20 bips, right? And you go, that vol is hidden by those metrics. The reaction is more extreme now because of the positioning and the flows, and so people think it's more important. And that's kind of one of the things I think is happening in software stocks.
So, Brent, I think this has to be maybe the wildest calm market of all time. Is that a good way to describe it?
I think that is actually a fact, Jack. That's a fact, Jack. Actually, I didn't mean to do that, but you probably heard that your whole life.
I have, yeah. It's all right.
I didn't mean to do that. I really said that's a fact. And there's a lot happening, and if you are invested in the wrong stuff, you are hurting or you're super excited. If you're an indexer, like 99.9% of investors out there, then you're like, well, just another day, so it's all good.
Yeah, it's like the crazy, and I'm just going to put this chart up because I saw it on Twitter right before we got on, and I thought it was really cool. Like in terms of the rotation going on, this is a tweet from Michael Botnick. And he said, wild market. We haven't seen anything like this since the dot-com bubble burst. Over the last 8 sessions, 115 stocks in the S&P 500 have declined 7% or more in a single day. The average drawdown when that happens is 34%. Right now, we're down 1.5%. So like when that's happened in the past, the market was down on average 34%.
Yeah.
And we're down 1.5%. Yeah. That's insane.
McElligott, I have a chart in our deck too that McElligott has a back test of this situation, which is also pretty nasty as well. And I guess when I think about that, I'm like, well, you got the Mag 7 concentration, right? Which if you look at the software stocks, for example, and you sum them all, they're a very small part of the S&P 500, if they're even part of the S&P 500. So it's like, not that software rules everything, but Mag 7s aren't even doing that well right now, So it's like what is breaking out is defense stocks and energy, and that's kind of about it.
Value, Brent. Value.
Is value still doing well?
Value's ripping this year, yeah. And so, I mean, the big differentiator, I think, has been small, like small over large to some degree. But even within small, there's a bunch of crazy stuff going down and stuff going up. But like if you look at it, like the small cap indexes are definitely up more than the S&P. But yeah, the value stuff's been pretty good. It's a really, really weird market. I mean, I can't explain it. And we'll talk about this more when we get into it because I always jump ahead of what you're going to talk about. But it is just interesting to think about what's going on beneath the surface versus what's going on at the index level.
Yeah, and if you saw the headlines, Pam Bondi said you shouldn't care about anything because the Dow's over 50,000, right? So,
yeah, and then she said it the wrong way, right, or something too. Wasn't it? I forget what it was. She quoted it the wrong. I don't know what she. It was some way that like showed a lack of.
Why do you care about the Epstein files, Jack? The Dow's over 50,000.
Of what's going on in markets, yeah, but nonetheless, we try not to get political.
Run off the rails. We should end it here.
Yeah. I mean, for making it till 2:40 before we got off the rails is actually pretty impressive for us.
At this point, no one's listening anyway, so we can say whatever.
Yeah, that's right. People are already gone. But before we start, I do want to plug 2 things. I never plug things, but I do want to plug 2 things. One is you were with us on our first episode of Last Call, which is our new attempt at redoing a market wrap show. And so just for anybody who hasn't seen it, you may want to take a look at it. We did it at the end of last month, and you pointed out some really interesting things that end up being somewhat prophetic here in terms of Core 1M, and some other stuff that was going on. So, if you get a chance and you want to see Brent and I telling the same terrible jokes we always tell, and my co-host and Matt and I also telling some terrible jokes, you can go over and check out Last Call. And the other thing is just, I want to point out that this video will come from both of us, but like you're doing some really good stuff over on Spot Gamma on your YouTube channel too. So, if you're watching this and you're subscribed to Excess Returns, if you hit the subscribe button anyway on the video, it'll pop up both channels. And, please subscribe to Brent on Spot Gamma. He's doing some great stuff. And if you've ever watched us and been like, wouldn't this be much better if Jack wasn't here and Brent was giving this himself? You can find that on Spot Gamma. So, just the analysis without the terrible jokes.
Well, thank you, Jack. That's very flattering, and congrats on the new show. It's a lot of fun and it's a cool idea. And thank you. I'm trying to get up to your level now. You leapfrogged my little YouTube channel a while back, as you should, and you have some incredible guests. So I'm happy to be a part of the Opex Effect, and yes,
Yeah, and we'll definitely be. We'll see if you'll come back. We're gonna ask you again to come to the next last call, and we'll see if you're willing to join us again, if it was too terrible.
yes, always back. One of these days we'll do it at the bar, and then we can really say some inappropriate things, and that'll probably
Yeah,
be
yeah,
the
I like
highest
that.
view video ever. So
I like that. If the bar will let us set up our little tripod or whatever, we'll get it done.
wish what Bob.
But I guess we should get into it. We should probably get into our options analysis here. But I do have to reference the lobster first, though, because people are probably seeing this thing on the screen and being like, "What's going on with this?" So
That is a
some
banger
great,
of an image.
it's some great AI imagery by you, Brent. Really, really
It's
good.
actually real. It's not AI.
It is, yeah, exactly. It's phenomenal. But yeah, and I think that's going to allude to maybe some of the things we'll be talking about in this podcast, I guess.
Yes, this is a nod to OpenClaw, which is causing a SaaSpocalypse, they've called it. Everyone thinks has to end in SaaSpocalypse. I'm sure most people know what OpenClaw is now. It's basically an AI agent that you can put on your computer, and it does all sorts of stuff like emails and blah blah blah. You know, I've been playing with it as a lot of people, and it's like it's cool, but it's not like there yet. But I gave me the opportunity to put a lobster attacking a stockbroker on screen, so there it is. But on this topic, you know, amongst Claude Code probably being a better reason for why SaaS stocks are down. IGV, which is the ETF we're going to talk about here, is down 30% this month, which is pretty nasty. And then you have stocks like Unity and AppLovin, which is a hilarious name. They report earnings and drop even farther because their CEOs just don't really have a good response to how they defend their moat, right? So the lobster represents SaaSpocalypse and OpenClaw. So that's the rub there. And there's some lobsters strewn throughout our presentation just to keep it light over here.
Oh, good. Good. And I know you've got like a bunch of stuff on the SaaS stuff as we get later into the presentation. Just one more thing I wanted to ask you about before we get into it is this gold and silver thing. So I think like last time, because I don't think you actually have that in the presentation. So I tried not to ask about things that are in the presentation so I don't take away from it. But like, I think the day we were recording last time was the day that gold and silver on that Friday, like went insanely down. And I'm just wondering, like, was there anything like you saw behind the scenes while that was going on? Like, were options playing a big part in that whole thing? Like, I'm just curious what you saw behind the scenes when that whole thing was going on.
Yeah, and shame on me. I should have had a couple slides on silver. What I could tell you about silver is one day, I think it was 2 weeks ago now, silver traded 6 million contracts, I think it was. It almost traded more than spiders on the day, which is just bananas. I mean, you know, spiders, the S&P 500 is $1 trillion market, you know, biggest probably asset in the world, I would guess. I guess U.S. Treasuries or whatever, but still, like, it dwarfs silver. And so that little ETF, SLV ETF, traded almost more on that day. I think silver hit 115 on that day, and that was the top. You saw the big boys come in and just slam that thing, and those names, silver and gold, have had a hard time, I think, sort of getting traction above that. Now, from my chair in the options seat, aside from macro landscape, the vol in that space is extraordinary. That goes for the commodity and the ETF, you know, and so when I think that vol comes in, you get a different type of trader coming in there. There are people who are not, you know, buying for manufacturing or investing for fundamental reasons. There's a vol trade in there, and I think that changes the way that the asset trades and sort of forms that top a little bit. And so for my chair, that's that, you know, that IV rank of 100, which you talked about a couple times, and then you see this volume that is the biggest volume, you know, you're ever probably going to see in an asset like SLV. That stuff corresponds oftentimes with tops because it's telling you that someone big is coming in. There's a regime shift there, and so, you know, that's certainly what we've seen for now. Now, does that mean that SLV's put its all-time high in? I mean, I don't know about all-time high, but it certainly seems in the short term that it's a little bit stuck. But in this weird monetary political environment we have, who knows, right?
Yeah, it was interesting too. Like that 4-quadrant chart you always put up, like the top right, I've learned, is kind of the place where it's like, this is probably not going to continue.
Yep.
And silver was way up at the top right, I think, last time we talked.
And we have some of those slides here later on, and you know what's up there right now is the software stocks. So so that'd be pretty interesting to see. And maybe then there's a presentation we'll just bring up. I'll bring up a trading view chart or whatever, and we could see where that silver top and that volume was, because I know we talked about it a couple times and see how that corresponds. So extra credit, we'll do that at the end. I also have a couple SaaS ideas. So if you're the type that's like, Brent, give me something that's mildly interesting, hang on. We have something. We have a projection ahead.
Nice. That's very important YouTube skill, by the way, Brent. Like allude to stuff in the future so that people stay with us. Uh,
It's like
you think I would have learned that after doing this for like 6 years or whatever, but I've not.
stay tuned.
But as we get into this, so we have to talk about why we're here, which is that as a long-term investor, I see these things happening all the time that I can't explain in the market. And you have a bunch of information behind the scenes that often does explain those things. And options are causing a lot of that. And to this chart you just put up here, the use of options by all kinds of different investors has grown dramatically since COVID.
That's right. Options volumes continue to explode. I need to update this chart for the 2025 year, but they just keep making more and more new highs. And they keep making new products. So what was the big event in the option space here since we last talked, Jack, was at the end of Jan, they rolled out Monday, Wednesday, Friday expirations in the names, the Mag 7s that you can see on your screen there. And I have a little extra credit slide at the end that shows you the volumes. The hot take there is it's hard to say that there's a necessarily stock impact, but those names are now trading a lot more options volume. And so if you think about the impact of 0 DT in the S&P, now you have 0 DTE essentially in these big single stocks. And so that's certainly more volume, certainly more activity, and I suspect that it unleashes some new trading styles that may augment or change the way that markets sort of function, certainly on a short-term basis. So the volumes, we think, just going to continue to grow, and the impact should continue to increase.
And I assume it's profitable to keep making these new expirations. So we're probably going to see more and more of that as we move forward, right?
Yeah, the exchanges love the fees. The activity in those products is really high. So market makers are happy with that. That gives more ways to hedge and express trading views. So who's to complain about that? And from the exchange side, they can sell us even more market data, which is, as someone who pays a massive market data bill every month.
You love that, right?
They love that. I mean, the market data bills, whew.
Yeah, I don't got that. I buy market data, but it's more like daily fundamental data. So that's a little bit, I'm sure, less expensive.
Right.
The type of stuff you're buying.
It's that low demand value stock data that who cares? Go to the yard sale and pick that up, right?
But as people are using options more and more, behind the scenes, we have these option dealers who don't want positions necessarily in these things people are taking positions in. They have to hedge their positions. It leads to flows behind the scenes. And that's a lot of what we talk about in this podcast.
Right. So the transmission mechanism from the options market to the stock market is hedging. And so when we all get together, we buy an individual stock or options on a certain stock, like silver or software, whatever it is. Market makers have to hedge that. And then they do that with shares of stock, right? So in this basic example, 100,000 calls trade at a 50 delta. Delta comes out of a Black-Scholes model, essentially tells us how many shares of stock do we have to buy to hedge. In that case, it's 5 million shares. So you can see those shares can add up a lot. And then that hedge is dynamic, meaning we're hedged right now at this time, at this price. If price moves, you have to adjust your hedge, so buy and sell more shares. If time passes, right, which it does, time moves, as you know, Jack, then you have to adjust your hedge. And then, of course, as volatility or options values change, these are independent variables that have to be hedged, uniquely, right? So there's this blend of factors that require hedging adjustments all the time, and that's what we're monitoring, right? We know what the position is, or have a great idea what the market maker position is, and then it's our estimate of how hedging flows can kick off using some of these metrics, and what the impact of that is going to be in the market is our ultimate goal.
And the reason you and I are talking today is because I didn't screw up the timing this time. So we actually are recording the Friday before the next options expiration, and this will come out on Saturday. So as we lead into this options expirations, positions build up, and then things change on the expiration, right? And there's room for the market to move after that.
Yeah, the third Friday of the month, even though we're getting these daily expirations, third Friday of the month is still the bigger expiration that's out there. And so we still track that sort of cycle, that 30-day cycle, even though there's kind of a shorter cycle that emerges. And as we get more Monday, Wednesday, Friday, single stock expirations, maybe we have to do daily Opex videos, Jack. But the point is,
I am curious though, will these become less important over time, you think, as all these other expirations come up? Like, do you see like 5 years from now?
I think so.
These will be a lot less. Okay.
Yeah, I think that's what it is. And stuff becomes more systematic and algorithmic. The tenor of trades seems to be shrinking a little bit. And so, the big boys will still put their big trades out on a quarterly basis because transaction costs for pure hedging, right? If you really want to hedge this quarter and buy an S&P puts, you got to go out, a month or two, or one of those bigger liquid expirations, for example. So, I still think those will be the dominant expirations, but it definitely is going to chip away at it and pull that positioning forward in kind of interesting way. So the point is here, though, that those expiration, the hedges have to roll off because positions expire, right? And then kind of the new cycle starts. There's data that backs the impact of this, as you can see here. 2 out of 3 times, so about 66% of the time, the S&P performance flips into and out of expiration. What does that mean? If we rally into Opex, 2/3 of the time we sell off, and vice versa. In this case, those stats are changed a little bit based on whether VIX expiration happens before or after. So you can see it's about a 10% difference there between the two. So 68 versus 58. And interestingly, VIX expiration is before Feb Opex here. So VIX expiration is Wednesday. And the idea there is that VIX expiration may be the start of this expiration window, which starts to create the regime change, the Opex regime change. Now, what is even maybe more interesting, if you look at this from a volatility perspective, RV stands for realized volatility in this chart. What are you taking away from this? If volatility is low, it tends to contract even more into expiration, and then it expands after. Vice versa, if volatility is whipping around into Opex, then it tends to calm after expiration. So again, there's that mean reversion quality in volatility space as well as price direction.
And then on this next chart, we're looking at you have the ability, basically based on gamma, to give an idea of what volatility will be on a one-day basis going forward, right? And right now we're kind of in that, we're moving up at least into a little bit of more of that higher volatility rate.
Yeah, so the x-axis here is our gamma index. It's how much hedging flow from a gamma perspective the dealers have in the S&P, and we run this at night, and then in the morning we say, okay, what is that? How does that correlate or measure with forward one-day volatility? So how much does the market move the next day? And that's what this y-axis is. And what you see is that the less gamma we have, or if we have negative gamma in the S&P 500, that tends to correspond with forward volatility. So the idea is, if you can see that dealers are positioned to constrict or keep volatility contracted or stifled, we can measure that via gamma, where sometimes they'll suppress volatility, sometimes they're positioned to expand it, right? And so this gamma data, again, statistically is shown to have significance.
And once the expiration clears, right, the more volatile we are, if we're not volatile, there's a chance for it to open up and be more volatile after the expiration. If we're very volatile going in, then there's a chance it goes the other way, right?
That's right. And so this chart here is updated just for the last few months to kind of drive home this point. Now, not every high and low has to be an options expiration, but you can see on this chart here, Jack, that we had this FOMC sell-off into December. What was the low of December? It was VIX expiration day. Then we bounced, right, into Christmas Eve. And then what was the market high? Jan Opex on the day. Then there's this big gap down. So, if you just measure what happened over the last two, and November was a major low, November options expiration. So, the correlation causation thing, you could say, well, that doesn't make sense, but every single Opex seems to kind of have, not everyone, but man, they so often, right? And so as we watch here, as we move towards VIX expiration on Wednesday and Feb Opex, it's an interesting one because there's not a clear market direction, right? And vol is kind of like in the middle, and price action is kind of in the middle, and I have some things to say about that, but this isn't one of those clear, like, market's trending into Opex so it can sell off after, right? It's very chippy out there. So this is a little bit tougher to call, maybe, I would say.
But by the way, violently going nowhere is definitely a candidate for the video title. That's very strong on your part. So if you're watching and you clicked on it, it might be Brent you have to thank for clicking on this video.
This is an art, everybody. So if you like my titles, that's great. But to the point of violently going nowhere, we did a measurement 2 weeks ago of the amount of intraday volatility versus kind of close-to-close volatility, because what's fascinating is a lot of volatility metrics, like, are based on close-to-close volatility, right? So if you're like, what is 10-day realized vol? You'd measure the S&P close-to-close to as that input. Well, on a close-to-close basis, there's so much mean reversion now that the vol doesn't seem that high. But if you look at the swings intraday, we'll have 1% to 2% swings intraday, and then the market only closes down or up 20 bips, right? And you go, that vol is hidden by those metrics. And so when you compare those two, close-to-close vol versus intraday vol, this is one of the bigger differences, right? Chasms that we've had, or spreads that we've had ever, right? You have to, there's only a handful of data points where this measures. And what's interesting is we took that measurement, I think it was last week, and the forward returns from these types of incidences were actually positive, which was like really head scratching, positive on a short-term basis, right? And so the fact that the market is sort of holding up, it's down a little bit today, but sort of holding up in the face of this volatility is interesting, but statistically that seems to be what happens. Now after Opex, I suspect that the tone is going to change. But the violently going nowhere just seem to be the right way to frame this thing.
What's interesting too, in terms of the close to close volatility hiding things, not only is it hiding the intraday volatility, but it's hiding like the volatility beneath the surface. That's even worse than the intraday volatility of like all these individual stocks going all over the place.
That's exactly right. If you just hold spiders in your 401k, you would probably not know that like XLK or software stocks are down 30% and housing stocks are up 15. There's all this stuff whipping all over the place. And I don't know what to say about the value stocks if anybody owns any of those, what's happening there. But under the surface, there's a lot going on. Value people are just probably happy that they're not down again this year.
So as we get into the expiration, we've got a very, very strong use of lobster clause here by you. So I'll let you explain it.
Yeah, the open clause. So in this case, what we have here is two measurements of the same data. This is how big is the options expiration to judge impact. Now, if you go onto one of the major financial outlets, they'll talk about how big Opex is in terms of notional value, and they will say something like $1 trillion. I don't like that measurement because what they do is they just take the amount of open interest and they multiply it by shares of stock because they assume that one open interest is 100 shares of stock. Kind of like a 13F jack that's misleading. So I included that in the upper left because a lot of times what happens is people go, Brent, your measurement says something much smaller. In this case, we're a little bit closer to 600 billion, but Goldman says 3 trillion. So Brent, you must be wrong. And it's like we're measuring slightly different things. So I like to look at delta because delta is the stock equivalent. And the two things that I take away from this are number one, S&P dominates like it always does. But we're very put heavy on the index side outside of the S&P. So what does that mean? Nasdaq, Russell, that complex is quite put heavy at the moment relative to calls. And S&P, interestingly, is pretty neutral, like 50-50. Normally is a little more weighted to calls. And so what you take from this is tech is getting beat up, which it is. But some of this other stuff, the diversified sectors, they're doing okay, I guess. The energies and the housing and I think, consumer discretionary defense is doing quite well, right? So some of that other stuff is maybe holding up a little bit better. But the SPX index itself, again, at 50-50 is like a very equal weighting. And to the point of violently going nowhere, it's like equal weighting, like kind of in the middle. Anything could kind of happen. And that's what the options market seems to be putting in terms of the S&P, whereas tech is really quite weak is the standout. And then what is the point of the lobster clause here? The key question is this a big expiration or not? Well, the full-on monster claw would be a quarterly expiration or like a December expiration. This one's quite small. So on my lobster claw rating, this is a 1 out of 3, Jack, in terms of size.
We got to keep this going forward, Brent, right? This has to be a permanent fixture at the Opex Effect.
I think so. Yeah.
It's a very easy way to like see how big is the expiration.
I know YouTubers are supposed to ask for comments. So if you want to keep the lobster claw rating, then we'll keep it in play. Let us know in the comments.
Yeah, tell us in the comments if you want to do it, because also the comments helps. Yeah, helps my algorithm to get more views. Just one question on that. In terms of so people are buying a lot of puts on the Russell, right? Is what you're saying?
And the NDX. So like what goes into the index non-S&P is the Qs, IWMs, NDX index options, and Russell index options, right? So that's what that sector is. And so, what always amazes me is just how small that is relative to the SPX, SPY, right? The S&P. It's like
it's nothing.
Sum of all options. You can add up all extra options, and they're basically equal to just what's in the S&P 500 index stuff. So yes, we're bearish on the Nasdaq Russell side of things, but that's only 7% of what's set to expire, whereas S&P is 50%, as you can see with the percentages here.
Yeah, it was just interesting to me because the Russell's actually been doing very well relative to the S&P this year. But also, I would think if I've got a portfolio of stocks of all these crazy stocks that are moving all over the place, maybe I'm like hedging to some degree at the index level by buying puts in the Russell.
I think that's totally viable, and you see that I think in gold and some of these other assets that have been doing pretty well, and even the Dow, for example, that sort of hedging flow. I also think that the tech sector is just looking quite weak as well. So I suspect a lot of that put volume is just downside bets on the NDX itself. Based on the way that the things we're seeing, just the price action that we're seeing. So I would guess I would estimate that that's more NDX heavy or NDX related, Nasdaq related than Russell related.
So as we head to the next slide, we can see more about the size of this expiration relative to some other ones.
Yeah, and this one's just the single stock deltas. This is calls versus puts, and I like to put this out there just to see what's going forward, what the big expirations are. And so to the point of this being relatively small versus March, March is, double at least, right? The size at the moment. So that just tells you it's a much bigger quarterly expiration. That could be a very significant turning point as we go out of Opex. So if we leave February Opex and we start to crash, for example, you want to circle that March expiration date. Because not only do you have a huge Opex, that's when the FOMC kind of comes up, and that oftentimes is a really major turning point. And so something to watch for those of you who are not kind of day-to-day traders, but more trading on a month-to-month type basis.
And so we always like to look back at what we said in the previous episode to see if we made any sense at all. And this first one, actually, you made a ton of sense, which is this core 1M thing I referenced earlier. That was flashing some warning signs.
Yeah, and we like this core 1M index. It's correlation index from the SIBO because it's the summation of a lot of things happening under the surface in the option space. And so kind of like if you were reading the weather and someone was telling you about barometric pressure and this and that and the other thing, and then you just go, what's the weather? And just go, it's sunny. You go, okay, great. And that's kind of what this is, right? Under the surface, what this is telling you is people are too bullish, essentially, in single stocks. And when you get below or down around this 8 level on the index, it's this sign that the bullishness is hit this like exuberant level, right? And that causes spasms. And so it's a very consistent measure over the last 2 years. When you get this index or this correlation metric this low, stuff starts to spasm. And lo and behold, that's kind of what happens here. And ultimately, what it is saying is the volatility complex needs to reset. And I think this is significant because a lot of times what happens in this market now, stuff moves and then people go and assign narrative to that move. They go, oh, okay, why did this fall? Well, OpenCloud launch or whatever. Or looking back, this is the reason. Whereas if you know that this correlation metric and stuff is saying, look, the vols are all offset in the options markets telling you that stuff is out of whack. Then when the market move happens and we get the spasm, you go, okay, the options market told us it's about to spasm. So, you shouldn't be so surprised, and you don't have to search for narrative in the same way. And again, not every sell-off is driven by the options market. I think a lot of them are increasingly. But when you see this stuff happen with such consistency, it sort of renders it, you're a little bit foolish, I think, for not paying attention, to be quite honest.
Is this more of a short-term indicator? Like if I see this and I'm like, oh, the market might spasm here, is it more likely to say this might be more of a short-term thing versus a long-term thing?
I think days and weeks, this is not going to be a signal that the market is going to make an all-time low now into December, for example. But the next 1 week to 1 month, you worry about it. Now, this is the chart from December, from January. So this is our older chart looking back at what happened, to be clear. I have an updated chart on this. But, in the days and weeks ensuing, it's suggests spasm. So what do you do with that? Well, you don't buy a 1 week put, you buy like a 1 to 2 month put. Because normally the other side of this thing, Jack, too, is that vol is generally very low. VIX is very low, or S&P vol is very low. What does that mean? Puts are cheap. Index puts very cheap when this is screaming risk off. So that's a nice alignment, right? You're buying cheap puts. Okay, well, like, what's the worst that happen? You lose a little bit of money on decay. Fine. It's different from like VIX is at 80 and I'm out there like buy puts and VIX is at 80 and then you get destroyed, right? Because your puts lose all your value. You bought very expensive puts, right? So this is a metric that continues, I think, to warrant watching. The other thing on that point about people being exuberantly bullish, this is our compass. What does this mean? If you're on the right side of this chart, that's extreme bullishness. So, you can think about Amazon, Google, everyone into earnings was like all bulled up and these stocks were all doing pretty well, right? Near all-time highs. And it was very linked in this way, right? So everybody was bullish on all these stocks. Very low vol in the S&P. That's what the y-axis is high options prices versus low. So if you have low options prices and everyone's kind of in this, lower white quadrant, very bullish, right? And high correlation in that single stocks are all bid across the board. So again, that syncs with low correlation on this index saying, all right, everyone's super bulled up. It's a crowded trade.
And this also highlights what I was talking about earlier. Like silver was on its own, basically. It was off away from everything else.
This is incredibly high implied vol in silver. IV rank of 100 means that the vol is more expensive. Options prices are more expensive now than they have been in the last year. This obviously is not only in the last year, but you'd have to look back decades maybe, right, to see a higher vol. And this is happening in the context of the stock going up or the asset going up. So stock up, vol up to an extreme that is screaming overbought, right? Now, that can be tricky to trade, but kind of the end is oftentimes near when we hit this level, right? And so that's going to play in here in a minute when we look at software stocks to the downside. Uh, in the NDX, realized vol is quite low, as you can see here. There's a decent spread between the two. And then on the point of on the point of asset vol, I should have included an update here because gold vol has gone bananas now, right? That's off this chart. But rate vol was very, very quiet. It's starting to lift a little bit. The VIX was low. NDX vol, low across the board in terms of vol across all assets. And all of this vol is starting to wake up, right? Rates, we're not going to get a cut. It doesn't look like, there's that macro stuff's going back and forth. Oil is up and energy's up a little bit. And, is there an Iran thing still? I don't think so, but who knows? So there's always that kind of risk, but assets now seem to be trembling in a way. So like, from last month to this month, there's definitely a change in the volatility landscape across assets, which I think is an important thing. Because look, if credit vol goes crazy, guess what? Equity vol is going nuts too, right? And that's an important thing to note. And on this point too, it's kind of interesting. Odds of a rate cut at the Jan meeting, went through the Jan meeting, no cut. Odds of a rate cut for March went to 20%. Then we got that jobs data, and then it went down to 10%. And I think that is another part of why stuff seems so kind of elevated. Last but not least, this is our term structure, and what we were saying was S&P implied vol is likely to remain elevated because of this signal, right? This is what we call forward implied vol, and it just says if you look ahead, what's the projection for implied vol for the S&P? And it was pinning higher. Oftentimes it's lower. So this told us that there's not a tailwind for vol to come down, right? There's like this headwind or this stickiness in implied vol, which did turn out to be true as well. So so I think that made sense. And then last but not least is this line in the sand, which turns out to be the same line in the sand, was 6,900. And that's this area, and it continues to be this area where there's a lot of risk below that level and some relative calm above. Now, we've not had a stickiness above that level, but that still is this line of demarcation between where things can really fall apart versus relative stability. So it's interesting that level is still in play here as we move, or we're a full month ahead from what we were talking about before.
So as we look forward to February here in your first slide, so we're starting to see a bid in puts?
Yeah, so if you look at the Jan presentation, I don't know if you remember that, Jack, but there's this image of this guy poking Jan Opex with a stick because it was like so boring, and vol was so boring, right? That was a summary, but we were seeing like these signals that was likely to kind of come undone a little bit, right? And it's come undone. Is it like VIX 30? It's going to show up on Wikipedia because it's been such a crash? No, but we're starting to see vol really start to move now, and to that point. This is what we call S&P skew. So if you look at 1 month options and you see this bulge down here, right? This is telling us that people are starting to get into puts, right? And this range is the teal band is 90-day range. So this is lifting. That's telling us that people are starting to get into puts. Now, what's interesting about this is that if you look at the overall level of vol, it's not that high, right? So this is what this is saying is this is the beginning of people starting to hedge. Does that make sense, Jack?
Yep.
This isn't like the event happened and we're going to hedge now because we have to. We're getting margin calls. This is people getting nervous. Now, does that mean the market crashes? No, but it adds fuel to a market crash. And just as you can say, we're nowhere near oversold signals in the options market, you could make an argument that you could squeeze a little bit of vol out of this thing and bounce us higher. Now, what's the catalyst for that? I don't know. But what's different now versus January is people are starting to hedge, and this hedging can create downside convexity. What do I mean by that? If we start to move lower and vol starts to lift, then you have this negative gamma dynamic that has to be hedged. And also if vol starts to pick up, then you talk about Vega as well, right? Or and Vanna, these terms that get thrown out, which I'll just say there's a lot more downside hedging that market makers may have to do if that put exposure is picking up, which it certainly looks like it is.
So is the idea here when people are slowly starting to buy puts, it could exacerbate a market decline? And I'm just trying to contrast that with, like, if people were going insane and buying puts left and right, it could signal a reversal, right? If it was the other way.
Yeah. So if you think about this, like, let's just talk about it in terms of the VIX, right? If the VIX is at 80 and you buy a put, you're probably never, ever going to make money on that put because it's so expensive. It's kind of like silver and buying calls, right? it's so expensive that even if the market continues to go down, your put's still not likely to pay. Why? Because the VIX is telling you that the prices of options is insane. And so when that is crazy, there's a lot of traders out there who go, I'm going to sell that put, right? Because I can make money even if the market goes down. The options are so expensive. I'm just going to do it. We use the analogy, right, Jack, of like, you don't want to sell your house, but if I offer you, 100 million for your house, you're like, here, I've never been to your house and I don't think it's worth 100 million, right?
It is
And you
not,
don't want to
no.
move, but 100 million, fine. Okay, great. So people come out and start selling those puts, and that can create the flow for the market to bounce when that vol is so high. Right now, VIX is at 15 to 20-ish, right? There's not enough risk there where you're like, I'm going to sell puts, because you could easily see the VIX go up to 30, right? Which would suck because the stock market goes down, which hurts your puts, and vol goes up, which doubly or triply hurts your puts. So we're not at the spot where it's like vol sellers want to come out, right? Puts aren't screamingly cheap, but they're not worth the premium. Like the risk premium isn't there for those sellers to come out. And if you're hedging, you're hedging something in a 1 month space where you're hedging something that's coming up, right? People are picking up on some risks ahead. And so I think that the hedges that are coming on here are saying like people are worried about downside here, and we haven't gotten downside, Jack, right? So there's
No.
nothing, if you own a put, there's nothing to sell into. It's like, did the market drop 3 to 5% and you're going to monetize your puts? Well, that didn't happen yet. Like the market hasn't moved. I would also say that if we were down 1% like we are now, and that skew didn't lift at all, what does that tell you? No one's hedging downside. They don't care, right? And that's a sign in and of itself. The market goes down, but no one wants to hedge. It's like, okay, this was just some sort of technical adjustment, fine, and we're going to buy that dip probably and move on. So the fact that the skew is lifting into downside is a signal that people are picking up on some risk.
So this next chart, we're looking at the usual chart we looked at before with the 4 quadrants, but now we're kind of seeing how assets are moving over time, which is interesting.
Yeah, that's right. And so what's interesting about this one is we put on this trail, and the trail shows the last 5 days of history. And I include that because I think the movements have been really sharp over the last 5 days around the jobs data. We had CPI today, which is not going to be reflected in this data, but there's been some macro data which has, I think, solidified odds of a cut or not. And so the trail is interesting because you see that silver vol come down, for example, right, Jack? And so remember, it was way up here. And now that silver's come down, I think SLV is around 70. You can see the vol is still rich, right? And people are in puts. Like, so the idea of silver catching a bid right here is not on anyone's radar anymore in the options market. And in gold, it's very similar, actually. That bullishness, right? That desire to own calls and lean into calls because gold is going to carry us out of whatever crisis is coming our way or whatever the macro whatever it was, right? That bid for calls is totally faded. Same thing in Bitcoin, right? These three assets are all, together. Interesting about Bitcoin is that it's getting pummeled still, right? I mean, we're at, last I checked, was 65,000, which is certainly lows that we haven't seen in a while. But the IV is not that high. And I think that's interesting because if you were having this panic fear washout, you would think that IV would be way up here. At which point, then, Jack, I may be like, maybe it's time to buy that dip. But we're not seeing that washout. Doesn't mean that you have to have the high vol to have the low, ultimate low. It's just the really high IV is a great sign of a low, right? And so it's something I watch. And then you just see that the trail here has gone from right to left, right? And that's picking up on the manifestation of people being bullish to, losing hope in a lot of ways. And XLK in this case is a great proxy for the software stocks. IGV is a bigger ETF for the pure software, but the vols aren't just, they're dirty, and so they give us some bad signal. I bring that up because you can see how these bounce. Software bounced. We had Unity and Apple even come out and just give horrible reports, right? Those stocks dropped, and then that sort of was the second leg of the stool for software getting kind of, revisiting lows. And so that's, very chippy. So that's the downside, but look at what's getting bid, right? Long bonds. And Jack, you know better than me probably that when people start to bid long bonds, it's a signal of, that's not really a bullish exuberance, equity bullish exuberance signal, right? And if you look at a chart of TLT and you go, oh, it could go higher. I'm not a certified technician there, but you could make the case that thing seems like it's bottoming on a quite a time horizon. So that bid in TLT is a new one, and you could tell because this is the 5-day history. So that long bond getting a bid is may be something that the equity market is really picking up on, and causing us some problems, and may cause us more problems here as we move into end of February.
This wouldn't be Opex Effect if we didn't have at least one bad macro take, so I will give one. What was interesting with silver and gold was that day we recorded last time that they were down a lot was the day Warsh was picked as the Fed chair. And
That's
like
exactly
to some
right.
extent, the argument was there's going to be less craziness, I think, with him relative to the high level of craziness we were expecting. And like to some extent, silver and gold have been a bit, the bid on them has had to do with craziness. Like the more craziness we have, the more they go up. So it was just interesting to see, and I think it hasn't gone, it's changed a little bit since then, but it was just interesting to see that and like the reaction to the Warsh appointment with silver and gold.
Yeah. And what's funny about that too is that we think about gold and silver crashing from those highs, and I try to make the argument that those things were crashing right from they went convex, right? And we should have the chart up here, but those things went convex at a ridiculous rate. You remember this slide here, we're talking about stock up, vol up in silver, right? And it's this huge crowded trade. They crashed up. And so you just needed a catalyst for it to finally sort of solidify that that is over. And then all that vol's got to come somewhere, right? And it has to express itself down. And that's basically what happened. So, I think if you look at a long-term chart of silver or gold, like the uptrend is probably still there. And you go, well, worse crashed gold and silver. They were crashing before, right? They just mean reverted to a trend. And there was no way they could sustain that level of volatility, right? It couldn't last. So I think
by the way, that gets into like a lot of what we're trying to talk about here, which is this idea that like my response there was kind of what you'd see on like CNBC or something, which is like there was this big move. Now I have to explain this big move with some sort of fact. Like, and the fact is Warsh, when the reality is maybe that was a catalyst or something, but the reality is maybe something going on behind the scenes played a much bigger role in that than who the Fed chair was.
Yeah, there are flows that had to unwind in those assets, and so Warsh just happened to be, maybe he was the final signal for that to sort of say, okay, like this can kind of unwind, and then that momentum spills to the downside. To that point, the silver ETF was what, 50 or 30 a year ago. It's still at 75, which this thing's still up whatever 10-20% in like 2 months or whatever. So I think that now you think like the demise of gold and silver are here, but they had to mean revert. Like there was no way it couldn't. The rate of change to the upside was just too fast, and the options market was screaming that. Took a little bit longer, I think, for it to mean revert than I had expected, I would say. But ultimately, you get that mean reversion and record options volume right at the top. So it's interesting, and I think that those are important signals to watch, particularly here where you see TLT getting bid, and you're like, well, that's a very liquid options market, so that's a real signal, right? And you can tell that there's this bearish quality to the market now, whereas in January everyone was bulled up. Remember, everyone was over here in this quadrant. So that sentiment has really shifted, and I think the concern that I have here is that yes, the sentiment has shifted, but that vol is not that high. You could easily jack that vol up, like to the point of Core 1M being at this very low level where you go, okay, like we've hit the lower bound of what vol can do now. Like we are at the trough. Like there's no vol can't really go any lower. Worst case is we stay at this level. Whereas now we're kind of like, it feels more like we're getting warmed up, I guess, is I guess the sentiment as opposed to sort of this oversold condition.
So as you know, I love a good heat map, and here you've got a Nasdaq correlation heat map.
Yeah, this is a fancy one that I pulled out of the box here because I was trying to put into context a little bit what the difference is between how single stocks move in the Nasdaq, in this case, versus the Nasdaq vol itself, because there's a lot of funny things happening. And I guess when I put this chart together, I was expecting there to be this very kind of aberrant data point where we're way down here, way up here, but what we're seeing is actually kind of normal, right? The level of vol in the NASDAQ sort of syncs with the level of correlation that you can see here. We're not really at these extremes, and I guess that's kind of what the theme of this presentation feels like it's coming out to be, is like, it's not yet too hot, it's not yet too cold, but like stuff is starting to percolate, right? We were down here on this chart a week or two ago, so we're starting to move up, and this is the spot where stuff starts to break. Like you get these highly correlated moves and vol spikes, and you end up with one of these situations where, this is where, again, something breaks, like a April of 2025 situation, or I'm not sure we had some vol spikes. Excuse me. After that, but we very easily could be working towards one of these events, which has me really concerned because Opex could finally release a lot of this stuff. Is the way that I'm really thinking about this. But that being said, I'm definitely leaning that way. So I want to be clear on that. I'm not like this is the way that it has to go. You could play devil's advocate. Well, they could sell vol down again and then spike the market back up. Like maybe, Nvidia earnings are on the 25th, I believe. So, that could be a little bit of a cleansing situation. But I think what the challenge is here is finding a vector to invest in, and it's not clear where that is. Like Mag 7s are kind of beat up. What's the story there? Software's dead. Housing and these financially related stocks. Well, if rates aren't going to go down anymore, do you still want to play in that space? So, it's a very cloudy picture at the moment, and risk now has moved to the spot. Like this is the spot that we crash from, right? You generally don't go from 0 to 100. You kind of stage at 50 first and then jump off, and we're kind of at that 50 stage, if that makes sense.
Yeah, and it's interesting because I was thinking like from my level at a fundamental level, like I was thinking about 2000 and comparing this to that. And, people always compare this to that and think it's the same thing, and it never, ever is.
Mm-hmm.
But there's two different aspects here. It's the same in that a lot of the behind the scenes rotation you're seeing is kind of similar to 2000 in that these types of stocks, these value stocks, these small stocks that are going up, that's what happened in 2000. What's different about 2000 right now is the market's not going down.
Yeah.
So the market was tanking at that point, and value in Russell 2000, that kind of stuff was up. Right now, the market's holding on, but you're seeing that rotation behind the scenes that's kind of similar.
Yeah. I think that's a very good kind of analogy. The rotation is there, and as you quoted at the start, like usually this means the market's crash, right? And Miguel gets back test of a data point I'm gonna show you kind of says the same thing. And so, as we're sitting here going like the market should have crashed, like we're sort of in the midst of this stuff happening. So a month from now, we could be doing the March Opex, be like, oh look, it crashed, right? So your point is the same, I think, is what I'm seeing here is like, this is the point where you jumped. Like we don't have to jump, but dang, this is a risky position.
Yeah, and that's the whole point is, it could play out either way. It could be a warning sign. We may look back at this and be like, this was a huge warning sign of what was to come. But also, like, this could be different than 2000 in that you get this rotation, but you don't get, the market decline that follows, or the rotation could unwind itself. And people like me who've been saying value is going to come back forever could be wrong again.
Yeah.
And, we get right back to I don't know the answer to this, as you know. Like, I'm more about thinking about possibilities than trying to figure out what's going to happen.
Yeah, and I think what we need to see is stuff move to some extremes, and for all those who are sitting here saying, "Great, Brent and Jack said buy it and sell it in the same sentence," there's some pretty clear levels where you can lean one way or the other, and so I'll talk about those in a second. And then I think there's some interesting trades that you could put on right now, and so that is sort of what this is. But there are times where it's like, look, everything is fine, and there's not a lot to worry about. Or and like the message of the last Opex Effect was, this is all too quiet. And so vol has picked up from those really low levels, but that's not crazy. Like if you're laying on the floor, the only thing for you to do is like at least sit up, right? So we're kind of like at that staged level. And I think like there are times where it's like worth risking a lot of your capital or putting your capital at risk because the waters are pretty clear and the skies are blue. And like right now, it doesn't seem like one of those moments, right? So that is one of the things to watch out for. On this point about when correlation spikes, so Jack, you can see when we were down here earlier this month at this kind of sub 8 level, the blue line is this correlation metric. We're now at 17. Well, 17 is this spot where it's like, so, okay, a lot of times like on this index, and I don't want to overweight discussing an index, but there's sort of like, this is kind of where it gets to be, and then correlation comes back down, stocks go up, right? Or you have these big spikes, right? And why this matters is because the green line is VIX. These two are very correlated. When correlation spikes, VIX also jumps. So again, maybe it's fine, or maybe we're about to have a 3 to 5% drawdown, right? And that's the risk. Is like there's not every day where that risk is really material, 3 to 5% drawdown, but in this case, it feels kind of material. We've in previous discussions talked about the quickening of this stuff, right? Where correlation drops real sharp. Trump tweets in October, market crashes 3% on a Friday. Everyone's like, what in the heck just happened? You're like, I don't know. And then what happens? Like a week later, we're up. November, same thing happens, right? Correlation goes down, bam, market crashes, Opex, we spike. So there's this cycle that seems to be quickening. Now, from an options, guy, I'll blame the options market, levered ETFs, whatever your reason is, it is what seems to be happening. There's a quickening, or the vol of vol just seems to be quite a bit higher. And so you see this in the single stock space too. We've talked about this in the past. Remember, NVIDIA drops 14% because of DeepSeek, right? And you go, why should the biggest stock in the world lose 14%? I think at the time it was the biggest market cap decline in a single stock in one day ever, right? My memory's a little fuzzy on exactly the date of that. I think it was January of last year, wasn't it? And so you get that outside. Then remember Trump and Elon start a Twitter fight. Tesla drops, I think, 15% in a day. And you're like, what the hell? The reaction is more extreme now because of the positioning and the flows. And so people think it's more important. And that's kind of one of the things I think is happening in software stocks in some way. But that vol is just much higher now. And I don't think that environment goes away. And I think a lot of that is related to the options market because we see these correlations. Like we have these conversations like, look, this is a risk signal correlation and vols are offset. This is a risk signal. And then the market, has these spasms, right? And it happens too much to be a coincidence where I think you have to respect that this is the impact of the options market on equities.
And this is, to some extent, this is why I love looking at this stuff because, so to give you an example, like think back to DeepSeek, right? So with DeepSeek, the market tanked. I think options played a big role in that, or certainly these stocks tanked, but there was an opportunity in that for people who could see through it, who are fundamental investors and are like, well, this name's going to be impacted, but this name is not.
Yeah.
And that's probably the same thing on the software side. Like probably some of these software companies are going to be like destroyed by what's coming in the future, but some of these other ones probably aren't going to be. So it's just interesting. Like if you are a fundamental investor, sometimes some of this other stuff can provide an opportunity for you if you can discern like which stocks are really down just because of everything else is going down and which ones are actual opportunities.
Right. And to the point of like the software space, I don't know which ones have a defendable moat, right? Or should persist to exist in the face of, Claude Code or OpenClaw or whatever other lobster system comes out. But the point of it is that as a fundamental guy, okay, I have to discount, their earnings now by 5% because of Claude Code, whatever your number is. And it takes you more than a minute, I'm sure, to figure that out, right? And so there's the correlation where it's like, okay, sector gets sold off because everything gets sold off. That makes sense. But maybe the sector should have only sold off 10%, but instead the sector is down 20% because of, the volatility space, right? And things happening in the options market. And so, to that point, NVIDIA and DeepSeek, maybe that should have been a 5% decline, not a 15% decline. And, so that dip becomes more investable because that the move is being exacerbated by these options flows, which is ultimately leverage. Like that's what options is. It's levered stock trading.
That's exactly right. And that's one of the things I think fundamental investors can learn a lot from your work, which is I can understand, this is probably worse than the fundamentals suggest because of all these other effects that are going on. Like if I like some stocks in this, in software, it might be a good time for me to take a look at those stocks because this has probably been exacerbated by all these flows and everything else going on.
Yeah. And gold and silver to the upside, it worked the same way. Like that convexity to the upside was, equity options, commodities, futures options, that just being levered to the upside, right? And so, if you understood that, maybe you would have saved, selling some of your silver at 100 or something like that. I don't know, but these are things I think you have to really kind of consider. Now to the point of, so this chart is dispersion. So how much movement are these stocks having versus correlation is about, are they moving in conjunction with each other in the same direction, right? And what I thought was interesting was to the point of software stocks and some of these other stuff moving so much, and you look at correlation, Core 1M, this is just an index, again, from the SIBO. Core 1M measures the top 25 names, maybe top 50, I'm mind blank, versus the SPX, right? So top stocks in the S&P versus the SPX index vol. And it's not that high, right? In honesty, it's not very extreme, but the movements under the surface are quite extreme. And so you say to yourself, well, that doesn't quite sync up, right? And why is that? Well, these software names, as an example, I keep touching on software, but they're having the biggest moves. What about crypto names, right? They're not in the top 50, so they're not going to infect or impact this index. But this is a dispersion index. Again, this is from Nomura, and what they're showing here is that stocks are moving at just insane amounts, right? The average stock there is moving 10%. That's just the average. Some of those are moving obviously way more. It's not the median, right? And the index is not doing anything. So how do you put that into context? Well, this is a great chart, and I put it in a few places. You got to go back to the internet bubble, Jack, which you mentioned before, and then the GFC, right? And then COVID, right? To hit this kind of dislocation, like this is pretty bananas, right? And you have to kind of find the right measurement to sort of unveil this this idea of how kind of rare this is, right? Because the correlation data in this case is not really picking up on it. And if you just look at the S&P price, it's like, well, whatever, nothing's happening. But this is very, very unusual. And the forward returns, I have to look them back up again, but they're all negative if you look forward on like a 2-week to 1 month basis, if I have that correctly. Quite negative. Not, and this is not necessarily today, tomorrow signal. It is a, weeks to as much as a month kind of negative signal, right? Kind of to what, again, you were talking about the top. So this is a very strange environment. And it is very disjointed, right? And I think the only way that it gets back to being sort of regulated is to the downside move, where everything sort of just resets and sinks back up. These things usually don't sort of reset to the upside. They don't usually sort of, get back in order in a rally. It generally takes a washout to kind of get it all resync.
And you've got some slides here with the craziness going on in software, which it's hard to even, it's hard to underestimate. It's like, it's so crazy. Like looking at some of these names. I mean, I know you've got Salesforce coming up in a few slides, but like, I think Salesforce is like 50% down, and it's a massive, massive company. Some of these companies just,
and 30% down this month. I got to be honest with you about this, Jack, that I was surprised was there was a similar move. This is obviously the tariff tantrum, right? And all that sort of stuff freaking out. And so, you start to put that into magnitude and you're like, wow, this is kind of like for the software guys, this is kind of a biblical, move in a lot of ways. So this matters for some of the vol stuff we're going to talk about and some of these other topics we were just talking about, is this just too much to the downside? And you talk about like CRM, yes, OpenClaw and Claude Code and all that sort of stuff, that's out there and it's real, but you're sharing your keys with everybody. The code, it breaks all the time. If you're a huge company, you can't just sort of like vibe code a CRM necessarily and have it be, so like the death of a lot of these stuff seems to be premature and overextended. A lot of banknotes are pointing to that. Like, of course there's winners and losers, but like a CRM is a great example where is a 50% drop warranted here? I don't know. And also you're going to assume that the company doesn't do something in response to this. It's a little tough, right? Very murky. It's very hard to forecast with everything changing how that's going to impact. But this is a very extreme, immediate move, right? This is not a trend lower. This is, this is a beating. And to put this into context, this is our compass, but I changed it slightly, right? So in this case, what this is put skew on the x-axis versus IV rank. Now, what is the difference? This tells you how expensive puts are, not versus calls, just how expensive puts are on a relative basis, specifically versus at the money options for you options nerds. And so what I think is fascinating about this is Into reports next week, I think it is, might be on the 25th. ADSK reports as well. And then you have CRM, Snow, Adobe's already reported, I believe, right? So these names have puts that are as expensive as they've been in the last year, which was through the tariff crisis, right, in April of last year. So that's incorporated in this data. So the IV is as high as it can get, and put prices are as high as they've been. These are 1 month puts. So if you think back to the silver being super expensive, or on the other side of the thing, everyone being super bulled up in these stocks, and you look at some of the stuff, you go, maybe there's a little bit of value here, right? Or at least there's enough vol that I'm going to be willing to sell some puts. This is me speaking, not financial advice. I might sell some options or sell some puts here because the vol's gotten so expensive. And not only that, if you look at CRM and Into, which are about to report, implied vol tends to contract after earnings, right? Even if the earnings are terrible, like in U was up here, they reported bad earnings, stock dropped, and the vol still came down. So this is, in my view, a great opportunity for options traders to come out, put on some put spread structures that would profit if that vol starts to contract. It's a sign of, to me, also very oversold in some high quality stocks. Now, I'm not a fundamental person, so I obviously don't know, but this high IV rank means, oh, this is on my radar now for something that I maybe want to go buy. Because here's another scenario, Jack. Maybe the rest of the market just catches down to these things. And so S&P drops 5%, but software just sort of relatively does okay because it's already paid the piper, right? I think that can be legit. Yeah. And on the point, Datadog, which is an S&P 500 member, they were up here, right, in this area. They reported the stock bounced. I haven't checked it recently. It was up like 10%, right? Why? Because it's a good company. It's not going to get killed by the claw. And so this is the claw man, and he's feasting on some of that expensive put skew. That's the little joke up there.
Yeah, to your point, I kind of wish I wasn't like, because I'm a quant guy. Like I don't pick stocks. My models pick them. And like I kind of wish I was an analyst who knew this stuff, because I would think we're going to look back and see that there were some huge opportunities in software for the people who knew the right companies to buy. And I think we're also going to probably look back and say some of these companies were doomed by what's going on with AI. And like the people who have the ability to separate those things are probably going to do very, very well if you look out, years into the future.
Yeah, I think that's true. And in the short term, they can bounce, which is my view. Out in the future, fundamental people kind of pick that apart. But I would say like Palantir's been killed, since Burry sort of flagged it. That was kind of the high, right? Now I think the stock's down to from 190-ish down to 130, if I remember correctly. So if you look at some of this, the puts are very expensive in this stuff, right? Microsoft, the puts are still very expensive. Palantir, even though the stock's all the way down from 190 down to 130, puts are very expensive. So those stocks are way down, but people aren't starting to sell puts in that space. Whereas if you look at like Datadog, which just reported, that put skews come way down, right? So the puts are much cheaper now after earnings. Stock got beat up, but they reported good earnings. They have a defensible moat, et cetera, et cetera. Seems like people are now starting to maybe buy that dip a little bit more, or at least the put values have gotten a lot cheaper.
So these next couple of slides reference Salesforce, which is what we talked about. It's been a crazy move.
Yeah, and I wanted to just sort of give an idea of how you look at this from an options perspective, and I realize a lot of people watching this may not be options traders, but here's why I think this is interesting. Forward implied vol is sort of our forecast for volatility. We can extrapolate based on this term structure where options prices should go, right? And so the argument here is that each one of these circles is an expiration, and so in this case, you would say, here's earnings. After earnings, I would expect the implied vol to go from this green line here way down to this dashed line, right? So that's about a 20-point vol change. Does that make sense, Jack? The difference between these two?
Yes.
So if earnings comes out, I would expect at the money vol to drop by 20 points. That's a lot, right? 20 vol points for this name is a lot. And I know that because when I look at this, I know the vol is all jacked up, right? 1 year highs in the vol. So if you go, and this is an April straddle, so selling the at the money options, in this case is the 195 options. And why I think this is interesting is because if you don't adjust the vol, so this is selling a call and selling a put for at the money for April, right? And you can see how wide the band is here, in which case we would project you making money just a few days after earnings, about 1 or 2 weeks, right? And this is what the dash line currently projects. So if the stock stays between 170 and 210 after earnings, roughly, you should make a little bit of cash, right? But if you adjust the implied vol because it's so expensive and you incorporate that 20-point vol drop, you can see the window at which this trade could be profitable expands a lot, right? So why I think this is interesting is because 9 times out of 10 vol drops after an earnings report. That's really good for a straddle. And then second, if the earnings are just sort of like, okay, no big deal, even if the stock bounces, 5 or 10%, this can still be a decently profitable trade because of the fact that that vol is just at such extremes, right? Now, you could take this and say, I only want to trade the put side of it because I think there'll be a bounce, or, you could do a bunch of adjustments. But I wanted to illustrate this because this difference between this dash line and this big green line here is the vol premium that suddenly becomes interesting as an asset to trade in when you have these really big vol spikes. And if people start to trade that vol as an asset, then it stabilizes the stocks themselves, if that makes sense.
No, that makes complete sense. You're looking at kind of the floor here, right? As we, if things do get bad on this next slide, what the floor might be.
Yeah, our risk offline has been 6,900 through from January to today, right? And the argument is when we're below that, expect, downside or soft market. Now we've been whipping back and forth up and down across that line. So normally I would expect a trend down. We haven't gotten that, but 6,900 is still the level. We're above that level. Okay, I think rally back on, then we start talking about maybe taking out 7,000, et cetera. But as long as we're below that level, right? Even today, we're bouncing a little bit. I think that we have to give edge to that sort of extreme downside. And if you started to say, well, at what point would the selling pressure from these dealer hedging flows sort of back off? In this case, we would use this GEX line, gamma line, as a barometer. And this thing troughs around 6,600 in the S&P. This tells me that the dealer hedging flows that may push the market lower would start to back off or reside or retract, right, in and around that 6,600 level. So we're at 6,800 right now. I think that after Opex, the chance of something like this happening maybe grows. And as long as we're under that 6,800 level, 6,900 level, I want to maintain some hedges to that. And if we cross 6,800, then I'm going to be, really pressing the bet that we start to visit this 6,600 level because it seems like that's where the washout would sort of lead us to.
So as we wrap up here, you're looking at these new Monday, Wednesday, Friday options. You're looking at what they've meant to zero DTE volume.
Yeah, and the takeaway here, just a quick note, because I know people are asking about it. The takeaway here is there's not anything obvious in the single stock space. We're only 2.5 weeks in terms of these options being launched. So market impact is kind of too early to tell, right? But what I did think was interesting is this is a 5-day moving average of volume for the names that was rolled out. NVIDIA and Tesla are already far and away the biggest single stock options. They've lost a little bit now, right? Which is interesting. And every other name that added these Monday, Wednesday, Friday options has increased in volume by quite a bit. And you can see the moving average here has really spiked. Now, market's been a little weird and blah, blah, blah. So too early to tell, but they're so far is the sign that the volume in these names is picking up quite a bit. And I suspect by March, certainly by April, we'll start to be able to suss out some actual market impact. So we're keeping an eye on this stuff. Volume is picking up, but ultimately a little too early to tell at this moment.
Well, as the action's picking up in the market, the action's also picking up in the Opex Effect. We got some more wild stuff to talk about.
Yeah,
and I'm sure we will again next month.
It's going to be great. And we do have a giveaway. If people want it, go spotgaming.com/Flow Patrol. We have a daily report. You get that for 5 days. It tells you where hedge funds are buying, the biggest contracts they're buying and selling. So a lot of interesting names show up in there. And a day like today, if people are buying app loving calls, then you would see that in that Flow Patrol report. So please go and grab that.
And just want to reiterate what I said at the beginning, there's a subscribe button. If you're subscribed to Excess Returns, it'll also allow you to subscribe to Spot Gamma as well. And check out Last Call, because we're trying to rethink a market wrap show, and it'll probably be a little bit of an up and down, as you'll see us potentially getting out of a private jet at the beginning, or maybe not, depending on if you're a believer in that. But check that out as well. And if you have any feedback, let us know. But thank you, Brent. This has been fun.
Appreciate it, Jack.
See everybody next time.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.